Wow. So last week, Trump came out and said that he was going to ban institutional buyers from buying single family rental properties. Let's dig into why he is doing this, how we got here, and if it is a good or a bad idea. It might surprise you the outcome of what I think on this information and the data backing it, because there's a lot of information on this topic and it may change the way you think about institutional buying across the board through this video. So number one, this is what Trump came out with. This was on January 7th, 2026. He said this high inflation, reaching too many people, and all this. He's going to now ban large institutional investors from buying more single family homes, and he'll be calling upon Congress to codify this action. People live in homes, not corporations. He'll discuss this topic, including housing and affordability proposals and more. And of course, you've already heard Trump has come out with a slew of different proposals across the board, including that to address the affordability issue, including assumptions of mortgages, portability of mortgages, 50-year mortgages, and now banning institutional buyers, including instructing Fannie and Freddie to purchase $200 billion of mortgage-backed securities to drive down interest rates. They know politically that they need to get the housing situation under control, or they'll start losing power in the House. And that's what this push is, to address affordability right before the midterm elections that are coming up this year. And so this is a really important topic that we all need to be focused on and figure out, does this policy really make sense? And does it make a difference right now? And let's dig into what that might be. So, just looking historically, over the last couple of years, single family rental properties became an asset class really after the great financial crisis. And institutions started buying rental properties off of the books of the banks. And then it started accelerating in specific Sunbelt areas where they said, hey, let's accumulate a couple of these, see how it goes. Let's slap property managers on it. They brought property management in-house, and they continued to grow their portfolio every single year fairly steadily. They're purchasing about 1% of all of the properties out there. So this is market share of U.S. home purchases by institutional landlords with 100 plus properties. This comes from John Burns Research and Consulting, and he's thankfully has done a lot of research on this topic. So we're talking about 1% of the purchases, but let's dig in, because it's not 1% across the board. It's in some markets, there's about 30% of the houses are purchased by the institutional investors. So who's actually buying? Let's dig in. Number one, Invitation Homes, Progress Homes, American Homes for Rent, First Key, Amherst, Tricon, Vinebrook Homes, Home Partners of America. You have heard of these companies. If you had, drop a comment below. Have you ever rented from one of these companies? We'd love to hear how your experience is. I used to be a Wall Street investment banker dealing with the repo lines for the assets pledged as collateral and securitize them and then sell them internationally and actually rate them out in on Wall Street with the rating agencies and tranche them out. This underwriting of these properties were fantastic. They were buying properties that were about 1,400 to 2,000 square feet, 4 bedroom, 2 bath, that were often, back in 2014 when I was doing this, they were $160,000, $180,000. Of course, those same houses now are 400 or 450 in a lot of the areas that they're purchasing. The idea of these folks were, they are saying, where are the migration patterns going to be? Where are people going to be moving to? Where is the affordability where you can get the best ROI, leveraged ROI, and we can get economies of scale in this asset class? And that was primarily in the Sun Belt. So these are the major institutional investors. A lot of them are public companies set up as REITs, and they pay off dividends, and their profit margins are about 20 to 25% across the board. And that's for running these rental properties. So where are they buying? Where are these institutional investors buying? Number one, Atlanta. Number two, Jacksonville. You can see here, Jacksonville is one of the largest ones. Charlotte, North Carolina, Raleigh, Indianapolis, Tampa, Orlando, Phoenix, Arizona, Las Vegas, Seattle, Washington. So they're buying in the Sunbelt area, these affordable locations that they've been gobbling up market share. But you can see from this data that came out from GAO Analysis of Urban Institute data, accessible data for established share of single family rental market held by investors with over 1,000 homes in selected areas. This is as 2022. I think 22 is perfect, because after 2022, the institutional investors stopped buying. at the end of 2022, they just stopped buying because the numbers no longer made sense with the higher interest rates. They just pulled back completely. But you can see they bought 25% of the single family rental market share in Atlanta. You can see in Jacksonville, they bought 21%, 20.5%. This is really incredible. In Jacksonville, Florida, where I'm located, we saw these institutional investors come in and gobble up. They poured capital in, they renovated these units, they jacked prices up, and they were buying the starter homes from first-time home buyers, and they were causing all this rental boom. Now, you may originally think that this is a very bad thing that could happen in your market by driving up prices, taking this really valuable inventory for families off of the market for a year or two, because the majority of a lot of the purchases happened in 2020, 21, and before 2022, before March 2022, when the Fed started raising rates. They gobbled up every piece of inventory. The wholesalers would find these properties off market and then instantly sell it off to these institutional investors. So the Sunbelt areas were the ones that had the biggest growth in this area, and Florida is one of the number ones. So that's where we're at. And we see these institutional investors, they were net buyers. And now if you don't take out the build to rent, now they're net sellers. And this is a huge information piece. We've got to talk about why, if you take out the build to rent product, why they're net sellers at this point in the market cycle. Now look at this overlap, because I think people need to understand that we're now seeing mean reversion, right? So we saw this massive growth in price appreciation and rent appreciation, and now we're just seeing it spiral back out the other way. Look at the areas around this map where we're seeing the 1-year change in metro level home prices between November 2024 and November 2025. What do you notice between these two graphs? This one here, take a look at it, and now take a look at this one. See any similarities of what's happening? The truth is, the areas that there was institutional capital going into caused the builders to have tons of confidence, and they overbuilt the areas, and they built tons of rentals, and they built tons of single families to sell to not just the investors, but to clients who are relocating from other areas to those locations. Now the builders overcalculated. They thought that migration would continue to go at the pace that it was during the 2020, 2022 time period, which it stopped. And now we're actually having a negative net migration in some areas, or a flat migration in some areas in the state of Florida. And now we're seeing prices come back down. It's possible we could see prices come back down all the way to 2019 levels because of the amount of capital and inventory that has been created in these areas because of these institutional buyers. Because when you're a builder and you build a house, you're going to say, well, I have a backdrop because I can always sell this house to an institutional buyer that's going to then turn around and rent it out. And there's a business model around it. So you have more confidence in building more because you have this capital backdrop. Okay. So keep that in your mind and look at this chart to understand what is happening. They bought all these rentals, they poured capital in, the builders went crazy. And then a couple of years later, the prices came down because the builders overbuilt those specific areas. Also, because they're adding more rentals. This isn't just inventory that comes off of the market randomly. That comes onto the market as a rental property, and we badly needed rentals during these time periods. Now they've built so much inventory from multifamily, the wild speculation of multifamily. We're still seeing it. We have a massive oversupply here in Jacksonville. And single family, we're now seeing rents come down across the board, which is fantastic. So we're having this mean reversion period because of the capital that flowed to our areas, and we have all this brand new product, which is fantastic to have. And now we're going back to a normalized market, and soon we'll shift into buyers and renters having all of the control due to the supply increases that we're seeing across the board. But the Sun Belt is the area that we're seeing the most decline in rents and the decline in prices. Same areas that these institutional investors were buying in. So people are really confused about what really drives housing affordability. There's a lot of people out there who reference this National Association of Realtors, which is institutional buyer market share rose 13% in 2021. And this is a chart that they referred to. Oh, the institutions bought up. Guys, this is very misleading. The way that NAR calculates this is it includes mom and pops as institutional buyers. It includes that 1 to 9 units, which is the majority share of the buyers of it in this chart. So this chart's title is simply just misleading, because obviously someone who owns 5 rental properties is not an institutional buyer. So please check the data behind the charts before you react to information, you go crazy on information or you call people out, right? So this is somebody who said, I don't know how I feel about the policy, but I do know how I feel about people like you who intentionally misguide others. Well, this person actually just did not research the information behind the charts, which I get, right? It's easy to go on X. I make mistakes too all the time. But you got to own it, right? So if you didn't do the research behind, hey, sorry, I ran it the wrong direction. But people need to understand that it wasn't the institutional buyers that drove up. That's not the root cause of why prices came up so much. So, and the reality is the buyers out there were actually the mom and pop buyers that somebody just owns 1 to 9 units were the people buying up the most of the homes. They were buying, they represent 80% of the single family rental market. So please don't jump to conclusions on this stuff. Most SFRs are owned by mom and pops. And I think there's a chart we have here that's really powerful that shows that. And here it is. They own 78.6% of single family rentals. You can see that here. 14 million single family rental homes. So this is a great overview by John Burns. So let's go through it. Number one is there's 148 million housing units. Okay. There's 9% of them vacant. This is as 2024. 134 million of those, 65% of them are owned and 35% of them are rented. Those are rental units. That's 47 million total rental units, and 66% of those are apartments. And then what we're talking about here is that 30% or 14 million units that are the single family rental units. You have to understand it's it's less than 1 million rentals owned by these institutional investors. Less than 1 million of these 14 million units are owned by institutional investors. So you really got to dig into this. And as you can see, the majority of the purchases are that 1 to 9 unit properties. That's the 6.6%. And then you have the 16.2%, which is the 10 to 99 properties. And the institutional buyers are these 1,000 unit properties, which are 1,000 plus properties under their management, which is 3.4%. Now, there's estimates all the way from 3 to 5% of these single family rentals are owned by these institutional investors. But you have to ask yourself, we're talking about 5% of the market here, and it's in very niche locations across the country, in the Sunbelt, especially in the Sunbelt areas. And now we're seeing prices and rents come down. So are these institutional investors a bad thing or a good thing? Do we want more capital being driven into these areas to build inventory, or less capital or no capital, so the builders will lose confidence in building entire communities across the board? You have to ask yourself, because we can all get behind the frustration of we don't want private equity driving up values of houses, but we also want their capital to be able to build more houses. So which one is it? Which one is it, right? So you need to decide. And investors are still buying today, right? So you have the iBuyers, that was like the Zillow offers, you see open door offers, all that, the very small sliver of the market segment that they were purchasing. Then you have the tier 4 investors, which are currently 0.5% of the purchases, which is very small today. They've really pulled back on their purchases in recent quarters just because the numbers don't make sense. And honestly, most institutional buyers that were buyers are now net sellers. We see them trimming their portfolio. So if you were going to do this type of policy, you would want to rewind time and go back to 2020 and all the way back to 2010 even, and do this policy of not letting private equity come into this space. I am not a fan of having any sort of ban. I want less government, not more government. I think that capital markets will correct themselves over a period of time. We're going to have run-ups, run-downs. It's fine. That's the market. And a government, whenever they step in, there's unintended consequences. And it's also a slippery slope. Are they going to start basically restricting other people from being able to buy single family rentals? What about these people who are the tier 2 investors, the 10 to 99? Maybe they say, hey, you can only own 10 properties. The government, once they get control of your assets or what you can and cannot do, they always take a little bit more, they take a little bit more, they take a little bit more. And I think there is a risk there with the government stepping in. I don't like them preventing and manipulating the entire market. Housing is already way more manipulated than it needs to be, especially on the interest rate side, to continue to prop up housing. And we see that with what the administration is doing now. They need to keep housing high for as long as possible. Why? Because 67% of the wealth in this country is tied in people's real estate. And if their real estate goes down, it's unlikely that they're going to get votes. And that's the way that it goes in this country. And then you can see that the other investors who are purchasing right now, and it's still 24.3% of purchases are going to investors, even today. However, the majority of them are these mom and pop investors or the 1 to 9 unit investors. And look, I get it. It's frustrating. The share of first-time home buyers is declining. This is a huge concern. People aren't buying their houses. They're not starting families. They're not having kids, and we're seeing job losses across the board. It is very frustrating for the next generation, but it's not because of institutional investors. It's actually because of the Fed's zero interest rate policy that they continue to manipulate interest rates to drive prices higher across the board. But what do you do when you can't drive prices and interest rates any lower and we're already near zero? The only thing you could do is have rates go up. But again, the administration says, hey, we want rates at 1%. That's just going to keep prices higher, manipulated higher, so you pay a higher price on somebody else's asset. I don't think this is good. I think it's very damaging long term. We're in a bubble that is, again, caused by the government intervening in the market to keep prices propped up. It's a very bad thing. What we need for the next generation is simple: prices to go down and stop manipulating our markets and just let them be between buyers and sellers and get the government out of our individual business. And I think this is a huge problem. And I even believe it's a problem for corporations as well with this institutional ban. We were pitched that we would have less government, and now we're seeing more government involvement than we've ever seen before in history in the housing market. So I think that's a bad thing. And I think we need to find some sort of market equilibrium. So, and we can even see that be the case again with that $200 billion of purchases left over on the asset program for Freddie and Fannie to be able to purchase MBS and hold them on their own book. Okay. We are going to be, if those go bad, we're socializing the losses and we're taking the losses as the taxpayer. I think it's bad policy. And I think we should stop manipulating. The best thing the government can do at this point is to just let prices fall and the next generation have a chance at home ownership. So, another factor from the institutional investors' standpoint is that a lot of them are actually now builders. So that this is a great thing. They're adding inventory. So this is something called a build to rent community, grew by a remarkable 102% across the nation in 2023. They'll build entire communities, usually around 200 homes, and they'll rent them all out. And there's now builders that don't work for the hedge fund for these REITs, and they just build on their own with the exit plan that these will be sold to the REITs as their liquidity. So I think getting rid of that liquidity by banning institutional investors is a big mistake. I don't think that it's a good idea. It's going to put a lot of builders out of business. They're going to be less confident in their ability to get their money back as they're being a backstop for what they build them for. And I think it's a really just simply bad policy, not well thought out, just like the other ones. It's just like the government just keeps throwing spaghetti at the wall and see what sticks. And unfortunately, they haven't come out with a policy that actually helps the next generation of buyers. They're just sending out policies that will continue to keep prices high, which I think is a big mistake. Look at this. This is Invitation Homes. They're a REIT. They're the large single family owner, and they're pivoting to the build to rent community builds. Progress Residential, the same significant rental portfolio. They're doing build to rent development activity. American Homes for Rent. They're already doing community development. Blackstone through Tricon. That's private equity. They're large institutional portfolio. They buy build to rent. All of these companies, they're doing this build to rent process. We want more rentals. That will bring rental prices down. So I think banning this across the board could be really detrimental to the marketplace. I'd love to hear what you think as well. Do you think this is a good idea after getting this information today, seeing where they're buying, the prices are already coming down, the rents are coming down? Do you think it's a good time to ban this institutional money from coming into the space? And just so you understand, it's now cheaper to rent than to buy. And this is why prices will fall. Consumers are not dumb. They're going to pick the one that's the best option for them. So buyers now have the negotiating power because they have real options because of all this capital that flew into the space, and they get to make the decision for themselves. I personally think that build to rent is a good thing. Capital in this space is a good thing. And you see this disparity, and it'll close over time because prices will come down and rents will stay just about the same because they have more supply coming on. These builders continue to build and finish out these communities, which is what we want across the board. And so we could see a situation where we see mortgage payments come down because prices coming down, and we could see rents come down because we have these institutional investors putting money into this system. So I'd love to hear from you after hearing everything that you've seen today. And this isn't new information that you haven't heard before. Is banning institutional buying a good idea? Is it a slippery slope, or is it a little too late, right? Like, why are we doing this now? We're only talking about 1%. If you were going to have a time to ban institutional investors, it would have been a long time ago, not today, when they're not even net buyers at this point outside of build to rent. Tell us what you're seeing on the ground. And if you've ever rented from one of these institutions, how is your experience? Comment down below. As always, thanks for following. We think big and question everything. And this is one of those things where we really need to dig deep and see if this policy makes any sense at all and why it's being proposed. I think it's just a scapegoat for another affordability issue that's just outside of the idea of just letting prices fall and mean revert after this massive run up we've seen of over 68% increase in price over the last 5 years here in Florida. Thanks so much for following. As always, you can follow me on X at John Brooks and sign up for my Substack below where I share information I can't talk about here on YouTube about the housing market. See you later.